let's talk, first of all, macro, and then we're going to dig right in. Greg, have we seen the lows for this market, or are we going to retest things back in October?
We have not seen the lows. I believe we've seen the highs, Dom. I do believe we'll retest those October lows. The odd thing is that I've been saying for a while now that the indices are too high and the yields are too low based on what we expect the Fed to do. But the yields after last week have come in right about where they were when we saw those market lows in October. The equity market's still not there yet.
Okay, so Greg, with that in mind, is this the time to put money to work, and are there opportunities?
Both of those things are true. So I do not think necessarily that I would have my highest exposure right now, given that I think the overall market is too high. What I do think will happen is that breadth will narrow as we go throughout the year. And we've seen the rally thus far this year, that the things that did not participate last year are really the high flyers of this year. And I think that will revert. I think that we'll see lots of money flow back to those things last year, because we're going to face a similar macro environment where I think the Fed has another 150 basis points to go in terms of its hiking. We're going to see the same macro environment where there are companies and sectors where we will get robust earnings growth. They will be few and far between, but I think investors will start to focus on that as the world consensus comes more in line with the macro view that I'm anticipating.
All right, so with that macro view, what's on the shopping list for Greg?
So a couple of things. We heard from the retailers that they are concerned about the consumer, and I think that this is a telling. Both Walmart and Target said that for their customer base, consumers are actually buying things that are non-discretionary, the necessities, which are lower margin. And so I'm still trying to figure out retail, because I'd had some hope that there would be some margin expansion there as supply chains normalize, but it doesn't look like that's going to be the case. That said, consumer spending is still strong, and the way to capitalize that, I think, is in the financial sector. Yes, they're provisioning, but this net interest margin environment is getting more and more positive. And again, I probably think it'll get more accommodating than most, as I see another 150 bps from the Fed. But even the credit card companies, if we think spending will be more robust this year, they obviously added record adds in terms of applications and consumers at near historic high APRs. The other area I'd look at is healthcare.
Sure.
Humanas, Uniteds of the world haven't participated this year. Inelastic demand, passing on those labor increases.